Greetings, and welcome to the High Flying Tutors Academy channel. Today, we will be helping you with the second part of the cash flow, our question 2 for cash flow statement, right? So, first, what we're going to do is to go through the question. After going through the question, we will come and apply our recordings and calculations on our answer sheet right here. So this is our answer sheet. This is our cash flow format. Down there, we've got our format for the reconciliation of profit before tax with the cash generated from operations. We also have our calculations, workings and calculations down there that we need to do, right? So we are going to start now. Let's go back and start with this question where we are going to go through the question paper, read and understand what is really required of us in the moment. So let's just start with question 2. They say the following list of balances were extracted from the records of Toy Limited at 28 February 2018, and then they gave us the list of balances right there, debits, and they also gave us the list of balances, credits, right? And then they also gave us additional information. Let's see. Transaction number 1, they say during the financial year ended 28 February 2018 with a cost price of 90,000 was sold at a profit of 2,000. The dividends declared during the period ending 28 February 2018 amounted to 35,000. SA normal tax for the period amounted to 173,950. Cash paid to suppliers and employees for the period is 272,650. All right, and then sales for the financial year ended 28 February 2018 amounted to 800,000 and cost of sales 200,000. All right, and then the total finance charges for the financial year ended 28 February 2018 amounted to, let's see, amounted to 8,300. Income received from investments for the period amounted to 8,500. Net profit before tax is 497,000. Required parts: prepare the statement of cash flow of Toy Limited with notes for the year ended 28 February 2018 in compliance with the requirements of the Companies Act 71 of 2008 and International Financial Reporting Standard. Ignore comparative figures, but show all the calculations. All right, so this is the information provided for us to prepare the cash flow, right? So remember, our number one item or our number one cash flow activity in the cash flow is to calculate the cash flow from operating activities, which under this we're gonna have our first item called cash received from customers. That is what we must calculate first. Cash received from customers. Cash received from customers. That's what we must calculate first, and then we're gonna have to record cash paid to suppliers and employees. All right, and then now remember, cash paid to suppliers and employees is provided in the additional information down there. So let's go and just record this one because it will save us time to just consider cut and paste. If you see it, you just cut and paste quickly, right? So it's transaction number 4, cash paid to suppliers and employees for the period is 272,650. Outflow, right? 272,650. So you come here and say open bracket, because it's an outflow, cash paid 272,650. All right, and then you put that in brackets already, and then the only thing that you need to calculate right there is going to be your cash received from customers. Cash received from customers, remember, down there we've got our workings and calculations where we have to say our sales or revenue, our sales or revenue, right? Our sales or revenue plus or minus our change in debtors. Remember, we say plus or minus because it can be an increase or decrease in debtors. Change in debtors can be an increase or decrease, right? So let's go and fetch our sales from the question that right there. So when we get here, transaction number 5 says sales for the financial year ended 28 February 2018 amounted to 800,000. 800,000. So we go to our answer sheet. We're gonna go to where we said sales or revenue. We say 800,000. All right, and then we go to our question paper in the edition in the list of balances right there. Under debits, we are going to check our account receivable or our debtors. Either this must be account receivable or debtors. Or debtors control, all right? All right, so we are going to check that if there is an increase or decrease in our debtors, all right? So as we check from the previous year to the current year, there is an increase in debtors. Remember, our increase in debtors is an outflow, considered to be an outflow. So we are going to record this. We're going to say increase in debtors or increase in account receivable. You can say increase in account receivable. Right? Or you can say increase in debtors, no problem, right? So now we need to do the calculation there. We need to do the calculation, right? So our increase in debtors, how much? Let's just go and double check in the question paper right there. Our increase in debtors, it has increased from 40,000 to 65,000. So we're going to say 65,000 less 40,000. How much are we getting right there? Let's just go and indicate this in our brackets there. 65,000 less 40,000. All right, 40,000. Let's see how much are you getting right there. Let's just put that on the calculator as I fix this one. Let's put that on the calculator. 65,000 minus 40,000. I'm getting an increase in debtors of 25,000. An increase in debtors of 25,000. So we are going to put that in brackets because it's considered to be an outflow. And another reason why we're minusing it is because, remember, there was an increase in sales through debtors. So people bought on credit. So it cannot be considered to be an inflow, definitely. So we need to take it out from where we're dealing with cash. It cannot be cash. So, but it's considered again to be an outflow, right? And then we can, as we were going through our question, we didn't find anything that is related to any other item that can be considered to be a receipt from customers. We only got those two, all right? Looking at this information, all right? So I won't share a lot of details, but you can put a question on the comments if you need more about this. But in this question, we only have sales and increase in debtors. Remember, if it was a decrease in debtors, when we calculate our cash receipt from customers, if there was a decrease in account receivables or debtors, we are going to add it, right? So now we only consider the two because that's the information we have. So you are going to say 800,000 800,000 800,000 minus 25,000. I got 775,000. 775,000. That is your cash received from customers that will go to the cash flow. Cash received from customers that will go to the cash flow. All right. So let's go up there to our cash flow. Up there to our cash flow. We're gonna record under cash received from customers. We're gonna record 775,000. 775,000. That is your cash received from customers according to the calculations that we've done. Then from there, we need to calculate cash generated from operations. Cash generated from operations. Cash generated from operations is going to be cash received from customers minus or less cash paid to suppliers and employees. Let's just do that quickly. 272,650. So how much are you getting right there? I am getting 502 350. 502 350. That is according to my calculation. I hope you are all getting it right. And then we have to also include other items that will form part of the calculations of the cash flow from operating activities. When we check on our additional information, we have got transaction number. Let's see. Transaction number. We have transaction number 7. Income received from investment, which is investment income. You can just call it investment income or interest received, right? So investment income, I'm going to start with incomes right there. Investment income or interest received or interest income. Investment income, you can call it investment income, or you can type it the way it is, income received from investment, no problem. It's like interest received or interest income, because when you invest any income from investment, it becomes an interest, because we invest to receive income in a form of interest. Of how much? Let's see how much is it right there. Is 8,500. 8,500. So 8,500 is an inflow. All right, it's an inflow. And then let's go and look for other items that qualifies to come there. We've got finance cost, which is finance charges. You can just say finance cost there, which are interest paid. Finance, you can just say finance charges or finance costs, no problem. Finance charges. All right, finance charges is an outflow because it's interest paid, right? So interest paid is in transaction number 6. They say the total finance charges for the financial year ended 28 February 2018 amounted to 8,300. 8,300. So you come there and say outflow, you put in brackets. Remember, anything that we pay, we put in brackets, or anything that represents negative in accounting, we put brackets. All right, and because brackets represent minus in accounting. Are you with me right there? And then we have to also calculate what dividends paid. Dividends paid. We have to calculate dividends paid. Dividends paid. So dividends paid, remember, you have to do calculations in the brackets there, right? So you have to go and look and check your shareholders for dividends. Shareholders for dividends there, you are going to take shareholders for dividends at the beginning. So shareholders for dividends at the beginning should be from the previous year. The previous year is 2017, and and the current year is 2018. So you're going to say opening shareholders for dividends of 30,000, right? So you go to your answer sheet right there, you say 30,000 plus dividends declared. Dividends declared, I saw it in an additional information right there. Let's go there. Additional information number 2. They say the dividends declared during the period ending 28 February 2018 amounted to 35,000. 35,000. So you go to this, you say 35,000, and then you less dividends. I mean shareholders for dividends at the end. Shareholders for dividends for 2018, which is the current year, is going to be how much are they? 40,000. You less 40,000. How much did you pay dividends? How much is the amount of dividends you've paid? Minus 40,000. You close brackets. Let's do the calculations right there quickly. It's going to be 30,000. You add 35,000. Dividends declared. You less 40,000. I am getting dividends paid 25,000. Dividends paid 25,000. It's outflow. Put in brackets. Outflow in brackets. 25,000. All right. And then we also have to calculate what taxation paid. Taxation paid. Taxation paid. So with taxation, it will depend on the information provided, because sometimes you find that you are owing SARS, sometimes SARS is owing you. So you'll need to figure out how much you paid them. All right. All right. So now let's go to additional information. We are going to look at SARS from the previous year and the current year. So if you check right there, our SARS is there. Previous year is 2,500. Previous year 2,500, right? Just for you to see the years right there. So previous year is 2,500. So for you to calculate SARS, you're going to say the previous year's SARS of 2,500. In brackets, you come here 2,500. You add SARS normal tax or income tax during the year, right? So let's go and see how much is it. It's in the additional information, this one. Transaction number 3, SA normal tax. That is SA normal tax for the period amounted to 173,950. 173,950. So you're going to add this one. You're going to add this one here. It's going to be 173,950, right? And then you less SARS at the end. You're going to subtract SARS at the end. So your SARS at the end, is 11,000. You less, you subtract that 11,000, right? So 11,000. Then you put brackets, you do your calculations. Then you will get your taxation paid. So your taxation paid is going to be 2,500 plus 173,950 minus 11,000. And then I am getting 165,450. 165,000 that I paid for tax. Open bracket, it's an outflow. 165,450. That is the amount I got in my calculator. All right. So I believe it's correct. And then now we are done with the items that's supposed to come and calculate our cash flow from operating activities, right? So now we are going to calculate our cash flow from operating activities. Cash flow from operating activities. So our cash flow from operating activities is going to be, we're going to say cash generated from operations of 502,350. Cash generated from operations of 502,350, 502,350 and then we add our investment income of 8,500. We subtract our finance charges of 8,300. We subtract our dividends paid of 25,000. I mean to say 25,000 are dividends paid, and then taxation paid of 165,000. We minus as well, minus 165,000, 450, and then I am getting a cash flow from financing activities of 312,100. I believe you all get that. 312,100. That's what I got. That is my cash flow from operating activities. We're done with that one, right? So we are done with cash flow from investing activities. All right, so we have to, operating activities. We are done with cash flow from operating activities, and we have to go and do the calculations for the cash flow from investing activities. We are going to jump straight to the investing activities, right? So our cash flow from investing activities, we are going to look at the non-current assets. So let's go and see what is it that we have right there. What is it that we have? Let's go and check. In our question, let's start with the investing activities. With the investing activities, let's see up there what we have. We have equipment. And we have motor vehicle at cost. So if you check, motor vehicle is not considered in the additional information, so it's going to be easier to calculate everything for it, right? It's going to be easy. It's not there in the additional information. It's only equipment that is considered in the additional information. So I want us to go and start with calculations for motor vehicle. So we are going to prepare a T account, a ledger account for motor vehicle, right? So let's just go there. All right, so we are going to say you can say motor vehicle, you can just say vehicle, no problem. All right, motor vehicle account or just a vehicle, no problem, is still okay. And then from there we're gonna look at the opening balance of this motor vehicle, right? So it's going to be balance brought down. Remember, it's an asset. Asset increases on the debit side, right? Of how much? Let's go and check how much is our opening balance for vehicle, and then we also have to determine the closing. So let's just put that as well. Balance carried down. All right. And then we don't have asset disposal because there was no way they said asset disposal, but I'm just gonna put it asset disposal. Asset disposal is 0 here because we didn't dispose any motor vehicle, right? 0 there. Fine, we got right, because there's no any additional information about selling a vehicle or whatsoever, so we are fine. So let's go to the question and check how much is our cost price for motor vehicle at the beginning of the year, right? Our motor vehicle at the beginning of the year is costing 150,000. There we go, 150,000. Okay, 150,000. So it's going to be our opening 150,000. Excuse me, 150,000, and then balance carried down, balance at the end let's go and check how much is our balance at the end. Our balance at the end for vehicle is 280,000. Balance at the end is 280,000. So by the look of things here, there's an increase in vehicles, because remember when we open with a balance of 200 with a balance of 150,000, I meant to say, but we are closing with a balance of 280,000. All right, therefore there's an increase in vehicles. So we don't have anything, we just have these two. So it means the bigger side becomes our credit side of 280,000, and then we're gonna close even this side with, balance with 280,000. All right, and then we come here, we're gonna have what we're gonna say bank. This bank is the one that will go to cash flow as additions in vehicle, or increase in motor vehicles, right? So it's gonna be 280,000 minus 150,000. How much are you getting there? Just put that on the calculator quickly, as I put this on my calculator as well. So it's going to be 280,000, you less 150,000. All right, so it's going to be 130. So this 130,000 will go to your cash flow, right? This will go to your cash flow as increase or additions in vehicle, or additions in motor vehicle in the cash flow. So let's just go up there to the cash flow and record this one quickly without any waste of time. So under cash flow from investing activities, we're gonna say increase in motor vehicle, right? Of how much? 130,000. An increase in motor vehicle is an outflow because you took money to go and buy additional vehicle. Money went out, cash out, right? When money flows out of the business, outflow, we put in brackets. All right, and then we are done with this one. And then we also have to indicate, we also have to do the calculation of accumulated depreciation account. We have to do accumulated depreciation account on motor vehicle. Accumulated depreciation on vehicle. Accumulated depreciation on motor vehicle. Let's just do that quickly. Accumulated depreciation on vehicle or motor vehicle, no problem. And then remember, accumulated depreciation account increases on the other side, which is this side, right? And decrease this side. So we're going to have opening balance on the credit side, balance brought down. All right, and then we also have to determine the closing balance carried down, the closing balance carried down. And then let's go there, because we don't have any asset disposal, so we can just put it there just to indicate so that people understand what we are doing. And just say asset disposal there, but we don't have it, right? So it's just gonna be 0. I'm not gonna do a lot of things, just for you to also master or understand the format right there. And then we are going to look at our accumulated depreciation under credits of motor vehicle. We have We have how much? We have there we go. I think we have 66,500, right? 66,500. So we come here, opening balance 66,500, and then closing balance of this is I think it's 80,000. Let's just double check. It's 80,000, right? So we put 80,000 and then end 80,000. 80,000 right there. All right, and then the bigger side here is the debit side, so 80,000 right there, even 80,000 this side. All right, and then we will have depreciation right there. Depreciation. So depreciation on vehicle is going to be 80,000 minus 66,500. I'm getting 13,500. 13,500. And then we are done with vehicle. Are you with me right there? We are done with vehicle. And then we also have to do the calculation for land and building to check if we have purchased land and building. Remember, I said investing activities consider all the non-current assets. You check if there was a purchase or a sale. Did we dispose any asset? So I'm gonna include this as for land and building before we go to equipment. All right, so I want us to do land and building account. Land and building. Land and building. All right, so land and building as well is an asset account. We're gonna have balance. We're gonna have balance brought down there, and then we're gonna have our balance carried down, which is the closing balance. And then let's go and check that first, because we are done with vehicle, right? Because remember, from the accumulated depreciation account, we don't need anything there. We're gonna need maybe depreciation when we go to the reconciliation of profit before tax with cash generated, but we don't need anything that goes to the cash flow statement, right? So that is why we're not taking anything right there. Because remember, depreciation is a cash non-item, or is a non-cash item. I mean to say is a non-cash item. All right, so let's start with the land and buildings right there. Our land and buildings, we're going to check the opening. The opening balance is 290,000 and the end is 320. Opening 290, closing 320. All right, so let's go to the answer sheet. Opening 290,000, closing 320,000, right? So now there's an increase in our land and building, right? So that means if you check the opening, but the closing balance is bigger of 320,000, right? Even this side 320,000. So the difference is an increase in our land and building. But we need to check if the increase, because remember, the land and building can appreciate the value. It can increase, but not because you bought additional land and building. Maybe because there was an appreciation of value. An appreciation of value is the same as depreciation, is a non-cash item. So let's go and check if we have, how did this increase? Did it increase because we purchased additional land and building, or it just increased because of revaluation. So we need to also consider that one. We also need to consider that one. So let's go and check in our question right there. In our question under credits, if you check, we've got the revaluation of land and building. You check the difference. The difference there is 30,000, because you have to say it's going to be 50,000 minus 20,000. So, and when we go to our answer sheet, when we say 320,000, we less 290,000. We are getting 30,000, which is the one of increase due to revaluation. So there's no cash involved in the land and building. It's just revaluation. So you come here and say revaluation, because it's equal to the revaluation that we got in the question right there. And then you can also indicate in brackets there that we said 50,000 less 20,000. Just to indicate the calculation. But also when we balance, when we say 320 minus 290, we are still getting 30,000. But now this is to confirm that this is your increase in increase in land and building of 30,000. So there's no cash involved here. We didn't buy any additional land and buildings. We just revalued, and we found that the value of the land and building has increased by 30,000. So there's nothing that's supposed to go to the cash flow from the land and building. We are done with this one, right? So let's proceed. Let's proceed. And then now we are going to start with our equipment. We are going to start with our equipment, because that is the third non-current asset, equipment. I want us to go and do that one. So number one, we are going to do equipment account. We are going to do equipment account. Equipment account, right? Equipment account is an asset account. Obviously, the opening balance will be on the debit side, the same as other non-current assets. Balance are brought down, and then also we're going to determine the closing balance. Balance carried down. Balance carried down. All right. And then now there's asset disposal, so we have to include it there. Asset disposal, which means we sold the equipment. Asset disposal. There's a decrease in our asset through disposal, right? That we sold the equipment. Are you with me right there? And remember, all this must be recorded at its cost. So opening balance, cost price of the equipment. Let's go and check that. Opening balance of the equipment right there. It's how much? Opening balance of equipment, 190,000, right? This one, 190,000. 190,000. So we go to the answer sheet. We're going to say 190,000 is the opening balance of equipment. Closing balance is how much? Let's check in our question there. It's 344,100. 344,100. We go to our answer sheet. We say 344,100. That is the closing balance, right? And then let's go to our additional information about this equipment. Additional information about equipment, right? It says, during the financial year ended 28 February 2018, equipment with a cost price of 90,000 was sold. So 90,000 cost price of that equipment that was sold is asset disposal. So there's a decrease of 90,000 in our cost of equipment. So you're going to come here and say 90,000. 90,000 is our asset disposal, right? And then which side is bigger? By the look of things, the credit side is bigger, right? So we are going to balance the sides. So it means we have to add the two. We have to say 90,000 plus 344,100. Okay, I am getting 434,100. which is our balance, even this side, which is our total, right? And then 434, 100. And then we minus 190,000. Then the difference, I'm getting 244,100. So 244,100 is our bank. We bought additional equipment to replace the sold one. Bank of 244,100. Are you guys following right there? And then this will go to our cash flow, right? This will go to our cash flow as replacement of equipment. So let's just take it there quickly. Replacement of equipment. Let's just take it to our cash flow quickly. Under investing activities, there is a replacement. A replacement of equipment. Replacement of equipment of, when you replace, means you purchased a new one. So money out in brackets right there, cash outflow, right? And then we have what? We are left with, because we sold, right? We sold. When we sold, it means we need to also do the calculation for the proceeds from sales of equipment. Proceeds from sales of equipment. All right. Let's see. All right. So we need to calculate proceed from sales of equipment. Proceed from sales of equipment. And also, what is another asset that we have? Let's see. On our deficit, I think we've got investments. They here. Investments, if you check that there's an increase in investment. There's an increase in investment. An increase in investment is an outflow because you took money from your bank to go and invest it into another account, which is an investment account, right? So that the difference of this, the difference between the 30,000 and 20,000 will be an increase in investment. So you can go to your cash flow. You can say an increase in investment or purchase of investment, no problem. And then increase in investments. Increase in investments, open brackets, 30,000. 30,000 less 20,000, and then you will get an outflow. That means initially you invested 20,000, now you top up the investment with 10,000. That is an outflow. When it becomes an inflow, it will be a decrease in investment. It means you have made a withdrawal from your investment account into the business. Now it will be cash inflow. But in this case, where there is an increase in investments, that is an outflow. All right. And then now we are going to deal with the proceeds. And then it means we are required to prepare what? The asset disposal. So, but firstly, we are going to prepare the what? The accumulated depreciation account. The accumulated depreciation account. The accumulated depreciation account. Let's see. On equipment. The accumulated depreciation account on equipment. All right. And then depreciation account, remember, it increases on the credit side. So it means we need to put the opening balance on the credit side, the way it increases. Balance brought down. Balance brought down. And then we also have to determine the balance carried down. All right. And then from there, we're also gonna need asset disposal, accumulated depreciation for asset disposal, for the asset that was disposed. So asset disposal. Asset disposal. All right. And then we will need depreciation for the current year of this asset, depreciation. All right. Depreciation, I'm just going to put it there. Depreciation. All right. And then, now this is the format, right? So we need to do the right thing right there. Okay. Now let's go and look for the opening balance of the accumulated depreciation of equipment. It's how much then? 90,000, right? We've got 90,000. We've got 90,000. Opening balance 90,000. Opening balance of accumulated depreciation on equipment is 90,000. 90,000. All right. Let's do that quickly. 90,000. Okay. And then closing balance of the accumulated depreciation, according to the information provided right there, is how much? 7250. 7250. 72,050. So it's going to be 72050. All right. So we've got all this, right? And then we need asset disposal as well, and we need asset disposal, accumulated depreciation, and depreciation for the year. And when we look at our information, it is not provided, right? It is not provided. So what do we do? There is no information about let's see, because when I looked at this, they did not give us information on how are we going to calculate like depreciation. All right. And then now we have to figure it out. How are we going to calculate depreciation? Because remember, either they're going to give you percentages and the cost and the method, we don't have, or they can give you cost price and carrying value. At least you can do a reversal of the calculation. We don't have. They just gave us the cost price of 90,000 and they gave us the profit. All right. So now this profit obviously qualifies to go to our asset disposal account. So let's go to the asset disposal account before we do anything else. Right. We go to asset disposal. We're going to record what we have because that's what we see, because it's a bit challenging now. So we are going to say equipment there. It's a bit challenging. Please pay attention. Don't worry. We are going to make it. Equipment. All right. And then equipment that was disposed, we are going to take the equipment that was disposed up there in this one. We're going to take this 90,000. This 90,000 qualifies to come double entry system, remember, 90,000. All right. And then we must also have accumulated depreciation this side. Wow. Okay. Accumulated depreciation. Let's see if we're going to get this one right. It's getting tough. All right. So accumulated depreciation, we have to take this one, and we don't have. We have to take the one up there in the accumulated depreciation, which we don't have as yet. So we leave it out as well. And then we also gonna need bank, of which we don't have as well. And then we've got profit. Profit must come on the debit side. Profit must come on the debit side. So profit on sale. We have profit. Remember, we have profit on sale or on sales. Profit on sales, it was given there in the additional information is 2,000 there, right? We're just recording what we have now. because we need to make sure that we get the right things. So let's see. Hey, Sergio Luke. Okay, so now we only have the cost price of the equipment with the profit on sale that we can record in the asset disposal. And when we go up there in the accumulated depreciation, we only have the opening and the closing. We don't even have depreciation where we can balance and all of that. So what do we do when things are like this? Because when I check the information, let me just go back to the information. Maybe I missed something, or this question is wrong otherwise, but let's see. Okay, the information for depreciation is not provided. At least if you can have that one, right? So now, since we don't have anything, we don't see anything, we are going to prepare what? Remember, we are in the test, for example, and the information that you need, you don't see. Go and jump to the next item. So now we are going to jump to the reconciliation because we don't see that information that can be used to calculate depreciation, or anyhow to calculate accumulated depreciation and banking asset disposal, because we're not given that. Okay, so let's go back to what we did not prepare, what we did not even start. We're going to do that, right? We'll see, maybe something will come out from there. Okay. All right. And then let's see. Just trying to fix this, and then we proceed. All right, there we go. Okay, now let's proceed. Now remember, we are leaving that one because we don't have the information. But let's come here. Maybe something will come out, right? So let's go and just do what we have. If we don't get it, we don't get it. No problem. At least we did something. All right. Now, the first item from the reconciliation is going to be our profit before tax. Our profit before tax, or net profit before tax, is given is 497,000. 497,000. So we're just gonna say 497,000, and then after that we're going to adjustments 4. So if you check adjustment 4, today we have got investment income. We have got investment income. We also have profit on sales. Profit on sales of equipment. And then we also have depreciation. We also have what? Finance costs, right? We also have finance cost or finance charges. Finance cost or finance charges, okay? So this one, remember, we are going to take the one we have up there in the cash operating. 8,500. But when it comes to our reconciliation, we are going to put it in brackets. 8,500. And then we also have our profit on sale is also going to be in brackets of 2,000 rand. All right. And then our depreciation, we only have one. Depreciation, we put in brackets, we only have one. It's going to be tough. We only have one, which is going to be depreciation on vehicle of 13,500. This one. Right, this one, we will take it to our reconciliation, right? But remember, in the reconciliation, we need both depreciation for equipment and vehicle. So we only have 13,500 depreciation. Then we have to add the one of equipment so that we can be able to calculate the total depreciation that must come there. All right, so we don't have that one in full, so we pass that one. And then we've got finance charges. Finance charges also, they don't have to be in brackets. Remember here, the items that must be adjusted for are expenses that must be adjusted for, we add them, and incomes that must be adjusted for, we less them. That is why we've subtracted investment income and profit on sales of an equipment, right? So finance charges, we're going to add, we have them, right? Finance charges, they are up there. We already have them in the cash flow, which is 8,300. But when we come to the reconciliation, when we reconcile, we don't subtract, we just put them in, because that side we subtracted. Here we don't subtract them. As I said, incomes that must be adjusted for, we less them, and expenses that must be adjusted for, we put them positively. All right, and then we are done there. Remember, we cannot be able to calculate operating profit before changes in working capital. Why? Because we don't have depreciation in full. Right, so let's go to what we have, what we can get. Number one, remember, we're going to check change in inventory. Our change in inventory, let's see if it's a decrease or increase in inventory. So our inventory, we're going to look at it under list of balances in the debits. Inventory, if you check inventory, there is a decrease in inventory, right? Because it has decreased from 54,000 to 40,000. So a decrease in inventory is an inflow. It means you sold more inventory and you received more cash, right? So you come there and say increase in inventory. Increase in inventory, right? Open brackets, 54,000 less 40,000. All right, so how much are you getting right there? Let's see. 54,000 minus 40,000. I'm getting a positive amount, an inflow of 14,000, right? And then we go to our change in debtors or account receivable. So our change in account receivable or debtors, it's here. We already got, it's an increase. So we can just copy this one. And just copy this one and bring it here the way it is, because nothing changes. All right. And then how much is it? It's an outflow of 25,000. We already explained this one, right? We don't have to waste the time there, because we still have a problem of depreciation that side. So let's not waste the time. All right. And then we go to the next one, which is our creditors. Change in creditors or decrease or increase in creditors. So our creditors, we're going to find them in the credits under balances right there. Right? So we need to check whether there's an increase or decrease in creditors. Right? So where are they? Accounts payables. Right? So we are going to say we check there. Our accounts payables, there is a decrease from 22,000 to 18,000. There's a decrease. So you go to your answer sheet there under reconciliation, you say decrease in account payable, or decrease in account payables. Decrease in account payables, open brackets, 22,000 minus 18,000. There's a decrease, right? We put brackets right there. And then the decrease, when I calculate here, I'm getting, let's see, 22,000 minus 18,000. I am getting 4,000 outflow, because it means you've paid your creditors. You've paid your creditors. And then 22,000 minus 18,000, I mean to say I'm getting 4,000. I'm getting 4,000 outflow in brackets, right? And then remember, now we are there, okay? Then cash generated from operations, remember, it must be the same, right? And we are done with this. So cash generated from operations, it must be the same as the one in the cash flow. So we can just copy and paste that one. Let's go and check how much is it. Cash generated from operations is 502,350. 502,350. So 502,350 must come here. 502,350 must come here. All right. So now we have the balance, right? We have the balance of 502,350. So we are able to get what? Depreciation. You see now, we are able to get depreciation right there, because we have to say, we're gonna remember the right way of getting this is to calculate, is to substitute from up there to calculate operating profit before changes in working capital. And then from there, we're gonna say working capital plus increase in inventory minus decrease in accounts receivables minus decrease in account payables. We will get our cash generated from operations. But now we have this one. We don't have this one. So what we're going to do, we're going to reverse the calculation from cash generated from operations. As we reverse the calculation, we are going to calculate our operating profit before changes in working capital. I hope you guys are following. So let's do that quickly. So it means we are going to say 502,350. We less 4,000. I mean, we add 4,000. We are reversing the calculation, because when we're going down, as we're doing the straight calculation, we had to subtract that 4,000. But now, because we are reversing the calculation, we are going to add 4,000. We are also going to add 25,000, and we are going to minus 14,000. Right? I am getting 517,350. That is your operating profit of 517,350. Right? You see now. So we are getting back to our depreciation, if you can check this, right? And then from there, we are going to say 517,350. We are going to less 8,350. And then we add 2,000. We also add 8,500. We also less profit before taxation, which is going to be 497,000. How much are you getting there? I am getting 22,500. 22,500. Did I miss something? Let me see, because it has to be let's see. Let's just start all over again. Let's see. We are going to say let's see if I missed something. Again, I think we are on the right track, ne? Because it's 517,000. Let's see. 350. We less 8,300. We add 2,000. We add 8,500. We less 497,000. I'm getting 22,000. 22,550. So that is the total depreciation now. You see now. So now we're going to get the depreciation for the equipment this way, because we're just going, because remember, this is the total of depreciations that we needed all along. So I'm just going to put a different color right there. And put this one. Okay, so this is what we needed all along. And now we have. Are you with me? You see how you do things. So every time when you don't get answers for something, you go around, you try by all means to get the right answer. And then from there, we can calculate depreciation for equipment, and it will allow us to calculate everything that we need. So now let's see. 22,000 minus 13,500. How much is it then? I'm getting 9050. So that is your depreciation for equipment that you needed all along, because there was no way you're gonna get that one except through this way, right? So now we are done with our reconciliation of the profit before tax with the cash generated from operations. Then now we can go back to our depreciation, our accumulated depreciation account in equipment, and our asset disposal on that. So let's go there. You see now, so these things are easy. Hey, we almost died there. All right, and then now depreciation for equipment is 9050. Now which side is bigger? Now the bigger side is the credit side. We added the two. 9,050 plus 90,000. You get 99050, and then you minus 7250. You minus 7250. All right, you minus 7250. So let's do it quickly right there. How much are you getting? Minus 99050 minus 72050. I'm getting an amount of 27,000. An amount of 27,000. It's our accumulated depreciation for asset disposed. 27,000. All right. And then we close. I can remember there we close with 99050. All right. So we are done there. Okay. with the accumulated depreciation. And remember how we got this 9050 is through reconciliation, right? So now we go back to our asset disposal. Our asset disposal, now we have got accumulated depreciation of 27,000 rand. Again, because if you check right there, up there, here, double entry system, we take this one, we bring it here. All right, now we can be able to calculate our bank. So now our bigger side is debit side with 92,000, because it's just going to be 90,000 plus 2,000. Even this side, we're going to put 92,000. All right, and then 92,000 minus 27,000, I'm getting 65,000. I'm getting 65,000. 65,000 is going to be proceed from sales of an asset. Proceed from sales of an asset. 65,000. So when you add 65,000 plus 27,000, you are getting 92,000. So that is your proceeds. This one is your proceeds. So there was no way you were gonna get this without the way we had to calculate our depreciation. So now we are done here. So now we can just put everything in the investing activities, and then we go to financing activities, and then we finalize our cash flow. So our bank of 65,000 is our proceeds from sales of equipment, and then we go to our cash flow inflow. This one is an inflow, 65,000. We don't put in brackets that one. It's an inflow. All right, we are done with the cash flow from investing activities. This is the most challenging activity that you have a lot to master from, right? And then now let's calculate our cash flow from investing activities. So on your calculator right there, you can just say negative. You don't have to do a lot of things there. You can just say minus negative 130,000, and then you say minus again 244,100, and then you say plus 65,000, and you say minus 10,000, and then you're gonna get an outflow. An outflow of how much? An outflow of 319,000. Let's go there. 319,100. Okay, in brackets, because it's an outflow. You got negative right there. So negative outflow. Okay, and then we are done with our cash flow from investing activities. This one, it will make you sweat. Okay, it will sweat you, this one. So it will make you sweat this one. All right, and then let's go to our financing activities, because we have been sweating from cash flow from investing activities. This is the most challenging activity in the cash flow. Remember, we've got operating activities, investing, and financing. So financing and operating not that challenging, but cash flow from investing activities, you'll get a challenge right there. So be prepared, be ready, know how to navigate through this. All right, so let's go to our cash flow from financing activities. Remember, cash flow from financing activities, we are going to be dealing with how do business finance themselves, and how do they pay back those finances that they finance themselves with, right? So financing themselves, one, they sell shares. So when they sell shares, we're going to look at the shares. All right, number one. So let's go and check the shares right there. When you check, you've got ordinary share capital, 1 rand ordinary shares, and then there's an increase from 260,000 to 320,000. So they have issued shares here, right? So you go to your answer sheet under cash flow, you say proceeds from issue of shares. Issue of shares or ordinary shares, no problem. And then open brackets, they improve from let's see, let's just fix that quickly. They increased from 320,123 minus 260,000. All right, so the difference is an inflow. The difference is an inflow, right? Let's do that calculations quickly. 320,123 less 260,000. I'm getting 60,000 inflow. 60,000 inflow, which is the issue of shares. It's an inflow 60,000. So we're not going to put this one in brackets. And then another way of financing is to go and borrow. Loan. So we are going to look at loan if there is an increase or decrease in our loan. If there is an increase in our loan, we want to borrow more money. That means there's an inflow. But if we made a payment of the loan when there's a decrease, therefore outflow. So let's go and see if we've got an inflow or repayment of long-term loan. Let's go and check that in our question. Under credits, we've got long-term loan. We're owing 140,000. Now we are owing 110. So we were owing 140. Now we're owing 110,000. So it means there's a decrease in loan. There's a repayment. There's a repayment of loan. You can say repayment of loan, or you can say decrease in loan. Decrease in loan or long-term loan. All right, decrease in long-term loan or payment of or repayment of long-term loan, and then in brackets 140,000 minus 110,000. There is an outflow there of, let's just do the calculation quickly. There is an outflow of 30,000. 30,000 in brackets. 30,000. And then we are done with the financing activities, just as simple as that. And then we're going to say 60,000 minus 30,000 obviously is 30,000. This one you can see. You don't have to use a calculator, right? And then now we are done with this information. All right, so now we need to do the net increase or decrease. Remember, here it's just the format from a different question, so it can be an increase, it can be a decrease. So let's go and calculate our increase or decrease. Let's go and calculate our increase or decrease in net cash and cash equivalent. Let's see. So for us to calculate this, we are going to say cash flow from operating activities of 312,100. We subtract 319,100. We add 30,000 from financing activities. So I'm getting 23,000. 23,000 inflow. So because it's not giving me negative. If it was negative, it was outflow. So 23,000, it's an increase. So I can come here and say net increase. Net increase, because if it gave me negative, it was going to be an outflow, therefore it was going to be net decrease in cash and cash. So now it's not net decrease, it's an increase, right, of 23,000. So let's go and check if we are in the right track, right? We are going to check cash and cash equivalent at the beginning. We're going to look at that or the bank. So let's go and check. If you check under debits there, let's see, under debits again. Under debits, we have got 11,000 inflow. Can you see that? Debits means bank is positive. Bank right there. It's not bank over. So it's the cash and cash equivalent at the end, 11,000. So we go there. We go there and put 11,000. All right, and then that's all we have on the debit, and then let's go to the credit to check if we don't have bank overdraft. And then under credit, we've got bank overdraft of 12,000. You see, so it's an outflow. Bank overdraft, it's an outflow. So we're gonna go to our cash and cash equivalents at the beginning and say open brackets 12,000. And then now we are done. So now let's see if it's balancing. If we say 23,000 minus 12,000, we are getting how much? 11,000, which is cash and cash equivalents at the end. Cash and cash equivalents at the end. So our cash flow is balancing now. We are happy, right? We cannot fail. Don't worry. We are master in these things. We can't fail. All right. We've got the best guy online. Okay. So yeah, that is our cash flow. It is fine. It is balancing. Everything is recorded. Everything is calculated correctly. Everything is sorted. We are happy with our cash flow. From right, left, and center, we've made it. So you can come and learn your cash flow here. All right. And then if you've got any questions, you put on my comments. If you've got anything to say, put on my comments. And please do not forget to subscribe to my channel. Do not forget to like and share to other colleagues or other mates or other friends you have that you know they need help with this information. All right. And remember that we also offer private sessions. We also offer private sessions. So if you want any private sessions, just put a comment and I'll attend to you. And salute. That's your cash flow.